Thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah, and the Talking Point today are the views of Sridhar Sivaram of Enam Holdings. He needs no introduction. He's been one of our favorite guests for a long time now, and it's been a hiatus of sorts between the last time that we got him and now. Sridhar, it's a pleasure talking to you.
Thanks for inviting me, Neeraj.
Uh,
It's always a
uh,
pleasure speaking to you.
Thank you. Sridhar, how do you analyze the landscape? Because we coming to the end of the year, so the year-end rallies, year beginning troughs notwithstanding, how do you view India vis-a-vis the rest of the world?
Yeah, so actually entering into 22, we were not as euphoric as the market was. I mean, there was IPO boom and things were all over the place. But we were of the view that the macro was looking very challenging. And our view was protect capital for 2022. I think broadly that sort of a scenario has played out, even though I would say that India has done much better than what we would have anticipated, given what has happened globally in terms of correction. Specifically, if you see what has happened to emerging markets, which is an asset class that we belong to, North Asia's almost got decimated, China, Korea, Taiwan. And I think relatively we have done extremely well. Within that, if you see, value has done better than growth. So growth at any price has got decimated. I think people are now trying to digest that there has to be a valuation sanity to any of these growth stocks, which is a good thing because people like us who are looking at bottom up also, it becomes easier to digest some of these valuations. Now, how do I mean, this is our view that the macro challenges globally have still not gone. I mean, let's put things in perspective. UK has, I think, a 40-year high inflation. Japan has, I think, a 40-year high inflation. US inflation is at 775. We are cheering. But let's just accept the absolute number is 775. So even for a moment, if I assume that over a period it comes down to 4.5, 5, even then it is a very high number as far as US is concerned because their benchmark is 2%. If we get 4.5, we should be very happy because our benchmark is 4 plus minus 2%. So I think the macro challenges remain. And if those macro challenges remain, what will happen is India may be insulated to a large extent as far as domestic consumption is concerned, but we do have an exports angle to it, which adds up to a fairly substantial number as far as the GDP is concerned, which will reflect in the current account deficit number. So I don't think the macro challenges as far as India are totally away. Within the overall emerging markets context, we look much better. But does it mean that we are in for a massive bull market? I don't think India can have an isolated bull market. We need the building blocks across the world for that to happen. We may outperform again, but let's accept it. We are up about 3-4%, so it's nothing to cheer about. So I would still be very cautious. At the same time, I know that there are opportunities. If the global environment improves, India will have a massive opportunity coming ahead. So we are treading very carefully. That's how I'll put it.
Okay. Yeah, somebody used the term, one of the MDs of, I think the SKF MD used the term, I'm cautiously pessimistic. So that was interesting. But Sridhar, so where you are slightly different than or the last set of conversations that I've had is that most people have the opinion that if the world does improve, that because India has already outperformed quite a bit, India may relatively underperform the other EMs or the other Asian markets, the likes of Kospi, China, etc. The BOFA Fund Manager Survey also kind of referred to that kind of a scenario. You believe that may not necessarily be the case?
So I think we need to put things in context again. So let's look at China. So the HSCI, which is the Hong Kong listed China stocks, the March 20, which was the COVID lows, roughly was around 8,000. Give and take, few points here and there. Our March 20 low was also roughly same, roughly there. Today we are at 18,000 plus minus whatever. They're at 6,000. Okay, so that's the context. So let's accept that they've had a massive bear market. In the last 10 days, we've had a 25% rally in the Chinese market. And these numbers are after that 25% rally. So I'm just trying to put things in context that they've had a massive sell-off, maybe for the right reasons, because, India, I mean, China is almost becoming non-investable. There are a lot of emerging market funds who are launching, emerging market fund ex-China. So I think those challenges for China and North Asia, which is Korea, Taiwan, because they're so linked to the US economy, they remain. Is it possible that they'll have, a sharp rally because they've sold off? It's possible. But if I look at, a medium-term period, I still believe that the opportunity for India to continue to outperform still remains. Can I predict 1 month or a 3-month, bounce from here? No, I'm not equipped to do that. And honestly, it may happen. I mean, we already seen that happening. But has the macro changed for them? I don't think, because I think China still has a lot of issues. And I think what has been underemphasized to a large extent is the chip issue for China, which is that the US banning chips to be exported to China. And that issue, I think, is a massive thing, because technology is a large part of the benchmark in China. And if they have, development issue, chips the high-tech chips cannot be made in China and cannot be imported. At least the experts tell me that this is pushing China back by about 4 to 5 years minimum. So I think how the market digests all these, only time will tell. I still reasonably am confident with how India's position, but short-term movements very difficult to predict.
Fair call. Sridhar, you have a great knack of figuring what the world might be thinking, and now with Enam is kind of a first port of call for a lot of global large pension funds or otherwise to kind of talk about as well. What are you sensing and what are you hearing? And they could be two different things. But what are you hearing and what are you sensing about how the global money is thinking about India at this juncture, wherein we've heard a lot of, China +1 and Europe +1 manufacturing heads talking about India. But I want to understand from the money bags perspective, how is India after the rally that we've already seen for the next, let's say, 1 year and for the next, let's say, 4 or 5 years or maybe possibly the decade?
So firstly, I think emerging market as an asset class, I think is losing favor. Emerging markets haven't done anything for 10 years, 15 years. And there was a Merrill Lynch report which suggested that almost for 30 years, the emerging market returns are, around 2-3%. Now, having interacted with many pension fund managers who put money in emerging markets, I can tell you that 5-year underperformance, they normally digest. 10 years is a red flag. 15 years is like, serious, introspection of what they're doing, because this is a asset class which is supposed to be more riskier. As a result, it should be giving you higher rewards over a period of time. Now, I think the patience after 10 years should seriously go down. After 15, I think there is no patience left. And during this period, even if for a moment, if we say that, okay, today is the low of the emerging market, so this is the wrong time to, look at this number. Even if you had done this number, say, at the beginning of 2022, the number would have been, not too different. Maybe 1% here and there. So my point is that emerging market asset class is seriously under question. And I've been arguing that, emerging market is not a homogeneous set of countries. You have current account surplus and a current account deficit country together. You're a petroleum exporting country and an importing country. You have a per capita GDP country of 20,000 and 2,000 together. So what is happening is the sum of parts is zero. So some country is benefiting and some country is losing. So over a period of 15 years, if this asset class hasn't delivered any returns, I don't see how people will be queuing up just because there has been a sharp fall. What may happen is that countries like India, which have outperformed in this period of turmoil for emerging markets and has delivered, say, 6-7% dollar return, may see favor. But in my past history, what I've seen is that pension funds generally avoid country dedicated funds because then they have to be sure that this country will continue to do well for, maybe 8 years, 10 years. That sort of outlook, nobody is able to take. If I take you back 5 years back, you would have thought that China is a great market to invest. Now it has become non-investable almost. So I'm just saying that which is the hindrance, that people prefer a group of countries. So maybe the Asia as a pack may work, not necessarily if they can remove or reduce the weight of North Asia, that would help. But I think MSCI is working on all sorts of combinations here. We'll have to wait and see how this plays out. But I think the outlook for India, even among emerging market and pension funds, is very positive, despite the fact that it's much more expensive.
Yeah, and despite the fact that the three examples that you gave, which is per capita, we are actually 2000, or we are a CAD negative current account deficit, and we are an oil importing country.
And commodity importing, other commodities
importing.
also.
Yeah, agree. So, okay. So is it the promise of earnings growth, Sridhar? What do you, so when you, for example, go out and meet people and not, I mean, not saying trying to sell the India story, but let's say talking about India, where is it that you argue as to why people should be parking money into India? Just trying to think out.
No, so we used to have a few slides in our presentation as to why India, and one of the big reasons for India was that the index composition is very diverse. So if you look at, say, index composition of Brazil, or you look at index composition of, say, the North Asian basket, which is Taiwan, Korea, they'll have some sector dominance. And the dominance is not small. It's like 40-50%. Brazil is like 50% plus is commodities. So when commodities do well, Brazil does extremely well. Whereas if you look at India's basket, they're roughly in the 30-35% range. And you can buy from a commodity to a IT sector to an MNC. A number of MNCs are listed only in India and in their host countries. So the diverse basket that India offers and has offered in the past also, it continues to offer, is something that we've always pitched for India, that even if the outlook for the world is bad, I can still find investable stocks which can do well. And obviously, if there is a massive macro impact, the markets correct, all bets are off. But generally, that's how we used to differentiate. And over a period of time, at least what we had seen and we had delivered is that India always had outperformed over a period of time, had generated alpha, not only as a country. So the country does well and you have enough opportunity to deliver alpha if you manage to pick your stocks correct. So that, I would say, is the broad pitch that I would still maintain that India still holds, that your diversity in your index and the stocks that you have is massive and you can pick and choose.
Okay, you sounding constructive, Sridhar, which is great music to the ears. Are you of the value bias currently? Because 2022, as you said in your opening answer as well, has been a year dominated by value in some parts in India as well. That has played out really. I mean, you can see it in the mutual fund performances, for example. What's your sense about what happens going ahead in 2023?
So the value bias stays, but we are gradually, at least my view is that maybe this is the time to start looking at growth, because a lot of these growth stocks have corrected, from their peak, possibly 50-60%, in some cases, even more. So we are starting to evaluate many of these growth companies, even some of these, the new age growth companies, not necessarily that we are buying right now, but we are at least starting to engage, starting to look if their business model works, not works, is there an opportunity? So I would say at the margin, we are tilting towards growth. And if you ask me, where have we increased our exposure in growth? Surely private sector banks. I mean, in the last 6 months, we have substantially increased our weight in private sector banks, and financials is our large overweight for us. We think it's the runway for the next 3-4 years for financials in general and banking in particular looks extremely good. And so, that growth segment we've already jumped into. The others we are still evaluating.
Yeah, it's a bit of a near consensus with what's happening with banks. Most people are doing that. Just wondering if I can ask a follow-up, because
Sure.
your sizes would be large. Would you stick to would you stick to the larger banks because they are showing as much growth, or are you also, or have you also fished into the slightly smaller market cap pond on the banking side?
So I would say that banks which have a good deposit franchise would fit into our theme, because there is going to be a fight for deposits. Loan growth you can achieve. Credit costs are at their all-time lows. I mean, I've met so many banks in the last 3-4 days. Almost every bank sounded the same, that the credit cost, what they're actually seeing, specifically in the retail segment, is much lower than what they had anticipated and have modeled. As a result, they're running a huge cushion because the credit costs, what they're actually getting is much lower. So the profits are going up, but they're continuing to provide slightly more, continuing to guide slightly higher, even though they know that these numbers will not come because they don't know why these credit costs are so low. Suddenly, the credit costs are behaving extremely, well. And we saw, one of the large banker saying that this is the Cinderella moment for, the Indian banking sector. Maybe it is a Cinderella moment. My view is we are still at the early stage of the party. It's still not well. So the runway is good. That's how I see it. Maybe it's a consensus, but I think the numbers will surprise most people. That's our broad view. But we think it's not just the private sector. We are bullish even on the public sector banks, where we are seeing the same thing play out. Credit costs are extremely benign, and they are seeing good loan growth. And there, the valuation comfort is even higher. So we have a basket of private and public sector banks, and we think the runway looks very good.
Very interesting. Actually, speaking of public sector banks, PSUs, Sridhar, kind of turned around the corner. PSU banks have certainly found favor. You are also telling me that defense is certainly a mainstream sector now. I was trying to do a piece. In fact, this week we're doing a conversation with 5 different defense companies just to get a sense of what's the on-ground situation. But it's a large basket to choose from. What's your sense on PSUs at large?
So actually, PSUs, we jumped in almost same time 2 years back, and it was very strange that we had a meeting with a large PSU chairman, and our view was just to get a sense what is happening. We were getting out of the first round of pandemic, and we wanted to know because the government had initiated a lot of credit guarantee schemes, so we wanted to understand how things are playing out. And to our surprise, as the meeting progressed, we realized that his market cap is lower than his pre-provision profit. I mean, that was the extent of decimation that a lot of the PSU banks had seen. Obviously, then we bumped up and we evaluated many others, and we were amongst the early to jump into the PSU banking bandwagon. We also then looked at other PSUs in general, and we found the same thing, that they were trading at extremely deep cyclical valuations. And honestly, at that time, one of the reasons to jump in also was there's so much of uncertainty at that time. We were first time experiencing something like that, and the idea was to protect your portfolio as far as possible. But those trades have really played out well, not only in the banking space. PSUs in general have done extremely well. Apart from the banking, I think in many of the other cases, we are evaluating now because they've rallied a lot and we are seeing more opportunities. As I mentioned, we're looking at growth stocks now. But as far as the PSU banks are concerned, we are still seeing them growth because they could see almost 40% earnings growth as a basket because their credit costs are still falling. Their NIMs may grow at possibly 15%, but the net profit may grow at a much faster pace. And so we think their growth still at a deep value. So that's how I would, comment on this. On the defense space, I think that looks very interesting. We are exposed to many of the defense companies, and it's not just the PSUs. Actually, what has happened is that the government has started to enforce the offset clause. Basically, if an MNC has a large order from Indian services defense company, defense orders, then 30% of that has to be manufactured in India. Only in the last 4-5 years, we've started really, implementing or pushing these MNCs to start manufacturing 30% in India or outsource 30% of that. We are seeing many companies in that space. So they have no direct exposure to the government. The exposure is to the MNCs. Global MNCs or global defense companies. And I visited a few of them. I visited the plant. They're really high tech. And what has happened is technology has also got transferred to India. So I think the government scheme has started to work. What seemed like an outsourcing arm now is also capable of manufacturing some of these because technology transfer has happened. So I think that's a very interesting space. There are a lot of companies which have come for listing and may come in the future also, and we are quite optimistic on that.
Okay, a couple of questions, please, if you will.
Sure.
So one question is on what you mentioned, which is for ease of understanding the platform names. Now there's a technical factor of this period being a period wherein there is a lot of supply which has come in, likely to come in every second. We're seeing a block deal in one or the other name.
Sure.
In one of the cases, we also seen the co-founder resign, by the way, on Friday. So yeah. I'm just trying to understand is this more a case of you having believed that the business model was good, but the valuations were not in favor, and now the valuations, if you can figure that out, is now more in favor? Or is there something else that has made you sit up and take notice?
See, as I said in the past, that I've lived through 99, 2000 as an investor, and I made so many mistakes. We paid, 50, 60 times revenue to Wipro, Infosys, and we know what happened. I mean, these companies survived. They were great companies, but these companies survived. There were many others where we paid 50, 60 times and the companies never survived. One of the other points which I highlight is that Z, which is a great company, it has still not reached the 2000 highs, and we are talking 22 years have passed. So is Z a bad company? No, the pricing was wrong in 2000. And having said that, we made the mistakes. Z was a part of the portfolio that we owned. So I think you learn from your mistakes in investing, that you have institutional memories. And at least my personal view is that at 50 times revenue, a lot of it is priced in, and it's very difficult to predict, especially in these new age companies, 1 year. And I have to now project for, say, at least 10 years. I don't think I have the capability to do that. Many other investors may have. So I have to, work with the limitations that I have. So we just stayed away. That it just doesn't add up. And that's not the only sector which is there to invest. And there are many ways of reaching the goal. So that's not the only, road available. So we stayed away. Now that, a lot of them have corrected, the managements have also become a bit more open to meeting. They didn't even want to meet. Many of them didn't want to meet us because the arrogance was so high.
Wow.
So now they are open. They're meeting us. They're engaging. They're explaining the business model. I think that looks much better right now, to engage, to understand, and to evaluate, and to see if it fits into the framework of investing that we have. If it doesn't work, we may still wait on the sideline and see if it corrects more, and evaluate at that point. Or if whatever promises they make, if they materialize, then we can jump in. Even if the prices have moved up, say 10, 15%, it doesn't matter. So that's how I would place it. I'm not saying that we're jumping into these new age companies, but I think things are looking better today than what it was, say, last year, same time, where the euphoria was, at a different level, which reminded me of 2000 at that time. And I said, okay, we've seen this movie play out.
Wow. Okay. My final question, Sridhar, and that's on the exporters. We've had two themes which were darlings pre-COVID or during COVID, both IT and spec chem, which have kind of seen some bit of gravity. But the companies are confident. Spec chem is expanding, putting up capex. IT companies are not talking about, maybe a little bit of caution, but nothing too untoward. What is your sense here on both of these?
Yeah, so I have different views on them. I'll first come to the IT companies. I think they are directly correlated to what happens to the US economy. And as if there is a slowdown or there is a recession in Europe, we already know that they're heading into a recession. The first thing that happens is discretionary spend is cut. We know from past recessions. And when discretionary spends are cut, one of the casualties is IT spend. So what we will see is that these companies are not yet seeing the IT spend cut as yet, but you're already seeing them cut their hiring growth, because they also sense that something is amiss right now. I think possibly fourth quarter they will bottom out. That's my sense. I could be wrong, because that's when most of the bad news will get priced in. So maybe that's the time to look at IT companies. But the other point to note is that if they're going to go back to say low double-digit growth, so then the excitement to invest is far lesser. So I will have many other opportunities or many other companies to invest, and we don't have a benchmark to worry about. So I can easily not invest. Many of my other friends who invest, who have benchmarks, they have to worry about it. So they have to, by force invest in it. On the specialty chemicals and chemicals in general, I think we're still very bullish. Yeah, there have been some cyclical issues. There are some companies which have had input cost pressure issues. But in general, what we see, the China plus one is here to stay. And now what is added to that is the Europe plus one, because the energy cost in Europe is so high. I mean, we met some companies who have European exposure, and they've had massive increase in their costs as far as energy is concerned. So that's how I would say that on the specialty chemicals, we still remain very bullish.
Got it. Sridhar Sivaram, such a delight talking to you today. Thank you so much for spending the time and talking to us, and look forward to have you more often.
Thank you. Thanks a lot, Neeraj. Nice.
Pleasure was ours.
Thank you.
And viewers, thanks for tuning in.